Hello, viewers. Welcome to Keymax Realty America Shopner Bari, a new episode. Today, we are delighted to have a distinguished guest, Mr. Rao Khan. Welcome to the studio.
Thank you so much.
And Mr. Khan has been in the mortgage industry over almost 40 years, 39 plus, right?
Right.
So, welcome to my show.
Thank you.
And this program, what we discuss about the home buying process, what to do, what not to do. And during the home buying process, a real estate transaction, there's many different parties are involved. So of course, mortgage is one of the most important because without mortgage, we cannot get to buy a house most of the cases. So please tell us a little bit about yourself, your journey to the mortgage.
Well, I started mortgage business back in 1987. We were licensed in 86. Application got licensed April 1st, 1987. I was one of the few brokers who got approved that particular date.
Wow.
And so that's when mortgage banking registration took place in New York.
Uh-huh.
Before that, there was no licensing. So we are one of the oldest one. So
you're the beginners with the license.
right.
Wow.
In New York State. So then the mortgage business was new. There were a lot of trial and error from both sides, banking department and consumer and us. Then over a period of years, banking department made good rules, regulation, and educational system, which they trained brokers, loan officers, and so on and so forth. As a broker, we lasted for a long time till 2000 came, and then we started to become mortgage bankers. So a mortgage banker up to 2009, then the financial disaster took place.
Disaster, yes.
And our business mostly was going to a bank, HSBC Bank. About 90% of our business went there because they had a special products that were arranged or created by me and them. So that was a great product to help our community, especially South Asian community.
South Asian communities.
And we had office in Jackson Heights, very large office, and we had all kind of people working there. And till today, when I go to Jackson Heights, a lot of people who own
They know you.
businesses, I walk there and they offer me tea, breakfast, lunch, whenever time. So I know a lot of people there. And so in 2008, the disaster started. In 2010, we were forced to go out of business. Not go out of business meaning not be mortgage banker because you require a large capital, you need warehouse lines, you need employees, you need underwriters, you need this and that. So it was too much to bear. So we decided to go back to being a mortgage broker again. A mortgage broker, you don't need all that. So we became broker again. So then I decided the broker was not working out. So in 2012, I went to work with different banks. From that time to 2000, so you can say 22, I worked with different banks, 8, 9 different banks. I was not doing what I wanted to do because I was always a broker, and broker mean you can do a lot of stuff, solve problem for consumer that you're dealing with, and still work in our community. So our community always had challenges, and they needed to be resolved and solved properly. So we did that, and we used to have a training room, first time home buyer training room. When my office was in Jackson Heights, we had about 100 people capacity to sit down in a room. And we used to teach them a class for about 5 hours and taught them everything from A to Z. And then people were knowledgeable about what they have to face.
You were giving a lot of knowledge to the community.
Consumer
and
must be educated one way or the other.
Yes.
Because more educated consumer comes to me for a mortgage customer, it's easier for me.
Yeah, definitely.
I can relate with them. I can use the language they will understand. But if they do not know anything, so it's like very difficult. Yeah, you can do a loan for them, but the consumer does not feel comfortable. They're always nervous. And unfortunately, the language that we use, sometimes they don't understand the meaning of it if they're not very educated.
Well, that's why
normal.
we're going to talk
Yeah,
today.
we are. So what happens there, we decided They will teach classes, and we start doing classes. And actually, even your office, I went there a few times, and we educate realtor who actually deal with
Now
consumer.
I have a new office.
Yeah, we will do the same thing here. And this way, the realtor, if he or she knows what's involved in a mortgage or property buying, technically speaking, not the legal part, I'm not attorney or real estate broker for that matter. I am just a mortgage broker. And my function is, whenever I do a mortgage, I take about 30 minutes to explain everything to the consumer briefly.
So that 30 minutes we're going to do here.
Yes.
So people can be educated,
Yes,
right?
very important.
So let's say a new buyer, a couple or an individual is planning to buy a house for their primary house.
Right.
Like what they really need to do, where they should start as a mortgage point of view. Could you please
Yeah.
share with that?
In mortgage, basically, Fannie Mae, Freddie Mac, FHA, basically these basic agencies, we deal with them every day, but then there's a USDA and other companies,
VA,
and
so
all
many
that. We
things.
don't deal with them too much in our community because we don't have Army background and so on and so forth. So we deal with first-time home buyer most of the time, or big property, luxury home buyers.
Right.
That's a different story. So when they come to us, we look through certain things. They are required by Fannie Mae, Freddie Mac, and FHA. There are 6 elements. First, most important part, we have to teach them whether purchase or refinance. Basically, it's purchase.
Purchase.
So we take a break, and we start talking about purchase, what is required. In purchase, there are first-time home buyer benefits offered by Freddie Mac, Fannie Mae, and FHA, all 3.
1 second. This Fannie Mae and Freddie Mac. I know you know, but can you briefly
Yeah,
give
Fannie
a
Mae
little
is
description?
Fannie Mae is a Federal National Home Mortgage Corporation. Another one is a Federal National Housing Mortgage Corporation, and then FHA is a Federal Housing Agency. These all are basically Fannie Mae and Freddie Mac are semi-government.
Semi-government.
Okay, and FHA is 100% government. So when people talk about conventional mortgage, you talk about Fannie Mae and Freddie Mac. Anything government-based mortgages are called government mortgages. Basically, that's what it is.
Okay.
The guidelines are similar, but FHA has more guidelines and also has more facility available. For example, credit score. If your credit score is not very good, you had late payments a year ago, so on and so forth, and your credit score is 680 or so, you don't have to worry about it because FHA will still give you a good rate.
Okay.
But if it's a Fannie Mae, Freddie Mac, your credit score has to be 780 plus to get the best rate. Only credit, speaking of credit, established credit history. So these basic things make them different for a loan officer or a mortgage broker to decide which way the customer is going to go. Where would he get the best rate? There's one thing, but at the same time, if you're putting less than if you're putting, let's say, 20% down, then we make every effort that customer should go to Fannie Mae, Freddie Mac loan because there's no private mortgage insurance requirement,
PMI.
PMI. And Fannie Mae, FHA, no matter what, you have to have MIP, mortgage insurance premium, added into your payments. So that's the difference, major difference we decide.
So can we please share MIP and PMI?
PMI is a private mortgage insurance, which is issued by an agency like, say, insurance companies, individual private companies. They insure the loan.
Okay.
In case if there is a default and
There is
customer
covered.
cannot make a payment, the insurance company makes the payment and the bank recovers most of his losses. But the customer pays for it. The beneficiary is always bank.
Bank.
Yeah, bank is the beneficiary. FHA is insurance. FHA doesn't make a loan. They just issue insurance.
Insure, yeah.
Loan is made by a bank, funded by a bank. They only issue insurance. And that insurance issue has their own guideline. It's called FHA guidelines. And you have to follow all those to get that insurance.
So that's MIP?
That's called MIP, Mortgage Insurance Premium, which is set by FHA. So if you put 50% down, you still have to pay that. Lesser, but
As long as the FHA.
as long as FHA.
Wow.
And VA is a similar kind of thing because federal government guarantees the loan.
Guarantees the loan.
That if this person doesn't make a payment, we
We'll
will make
take
the
it.
payment. We'll take the house or whatever. So there's a variation in each. So, but conventional mortgages, most people go through conventional mortgages nowadays because they offer, Fannie Mae offers first-time home buyer benefits. Freddie Mac offers a first-time home buyer benefits. So you can have a mortgage even when you don't have a credit. You know, you don't have credit score, but you can have a alternate credit.
The alternate.
Yeah. So alternate credit meaning we take your rental history, we take some automobile payments you're making, not to a company, but you had personal bought from somebody privately. You're making payment. Then you have your some other maybe to insurance company, to a dental doctor bill or something that you're making payments over a period of time. So if you can give 2-3 sources, then that could help us to build the credit. And then we can go to Fannie Mae and Freddie Mac and say, look, this person doesn't have a credit, and these are the credential he or she has. Can we use these? Obviously, they say yes.
That could be your utility bills too?
Yeah, utility bills, one
Car
of them.
payment.
Car payments. Yeah, not
bill.
telephone bill. Anything that you make payments, there's no loan involved.
Okay.
If there's a loan involved, that's a credit.
That's a credit.
That's a credit. So we build that for a customer. So there's a first-time homebuyer program with Fannie, Freddie, and also FHA. Fannie, Freddie don't have one; they have 2-3 different types. A lot of them will help you to buy a house that requires repairs. It's called Fannie Mae Home Style, for argument's sake. They will give you money to buy the house and fix the property. The process you have to go through, and you can buy a home. Because other way around, if a house requires repairs and this and that, Fannie Freddie will not make the loan. Okay.
So now, when a new client comes to you, first-time buyer, how do you educate them the income and the credit?
Yeah,
Like,
we look at
what is the impact?
6 items.
6 items. Okay.
Yeah. Let's start with the credit since we're discussing credit. We run a credit report, nowadays called soft pull. It doesn't affect your credit score. That's what it means. And it's not the same as you pull through your cell phones because we run 3 agencies and those agencies are designed for mortgage purpose only. We look at them if they have any problem on a credit. For example, the credit score is low, but they have not made any payments, late payments. They always made payments on time,
Okay.
but the credit score is low. Basically, what it is, a credit could be new, meaning they just opened the credit about 6 months ago or a year ago. B, it could be the loan they were approved that they $10,000 line of credit, and they have already used $9,000 or $8,000. Okay, so that will reduce the credit score. That's another factor. If they made a late payment into the credit within the last 12 months or 24 months, it will have a big impact
Big impact.
on the credit score. If the payment was more than 2 years ago, it will not have that much impact, very little impact.
Very little impact.
But if you have those, they allow this by law. They allow this. There's a program available in credit agencies, TRW, TransUnion, Equifax. They have all that. So what you do is you go to what if I did this, okay? And you go in changing things. What if I were to pay this credit card bill? It's 10,000 line of credit. He owes 9,000. If I were to pay 7,000 on this, what will happen? So you keep on going like that every card, and end of your exercise, you'll see his credit score is not 660 anymore; it's 770.
Wow.
So you can help the customer on that. Obviously, we cannot charge them for that, and we usually don't do that because it's very expensive. So customer comes to us early stage. If we start doing that, we'll go out of business. So we then just simply tell them based on experience, do this, 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 this. And then we'll go back to soft pull that I mentioned earlier. We'll go to that credit, which only costs us $20, but that's reasonable. When you do other things, that's very expensive. So then they do that, and then the credit score goes up, and then we start the mortgage. But on purchase mortgage, it's not, you don't have that much luxury or time to do that. So then you have to go to the other method. And then, like I said, that's expensive.
So
It would cost about $300-400.
you educate them the credit,
Yeah.
the impact. How about the income? And
That's
down
one
payment?
thing with credit score is important. We go in a lot of detail. Obviously, we don't have that kind of time. We go a lot of details explaining to the person you can do this versus this. A lot of time, a person has a credit problem. It cannot be solved, obviously. So we ask them to replace a co-borrower, bring a co-borrower, co-signer. We look for that because they want to buy homes. So we go through all possibilities to help them. And one of the major questions when we face all the time that when we talk about or mention that please have a co-signer, and they're afraid, they think if I bring somebody to my house, he or she will hurt me. They can take my house away, they can do this, they can do that.
Yeah, the
Actually,
fear. Yeah.
So what you do is you use them as a co-signer. You don't put them on a deed or title.
Yeah, you take them off
They're
the
not
title. money.
they're not occupying a house. So you have non-occupying co-signer.
Non-occupying co-signer.
So
Wow.
the only person who gets hurt in this transaction is a co-signer.
Co-signer.
Because if you make late mortgage payment,
His credit
his
is
credit is ruined. So I always tell people, make sure that you are responsible when somebody's helping you, that his or her credit is not affected. Okay, so most people are responsible. I don't see much problem with that.
Most of the
But
people are
yeah,
very
people need to
they wanna
understand
do the
that.
right thing, yeah.
But people are afraid when somebody says to them, well, you can bring a co-signer. So you have to have a co-signer, make a non-occupying co-signer, and then the loan officer, or mortgage broker, whoever you're working with or bank, then they will work out the situation for that purpose. So there's a credit. Now we go into income. Basic requirement of income is you must have at least a minimum 2-year employment history. Now, 2 years employment history does not mean it has to be with the same employer.
It could be different employer.
It could be two employer,
But he got to be employed for 2 years.
2 years minimum,
Minimum.
And currently employed.
Currently employed.
Yeah. And if a person is employed for 2 years and in between change one job or maybe 2 jobs, it's acceptable. But if you change all the time, 5-6 jobs, I don't think the bank allows that.
Oh, just
Because then he is not stable, he's not dependable, his decisions are not right decisions. So he's making a decision, but it's not a good one for even for himself. So when you have job change all the time, that's not good.
that's not good.
But if you have, it happened in COVID time, a lot of people were laid off or fired.
Yes.
And then they got another job in a different field, and they were there only for 6-7 months. And Fannie Freddie will take them, FHA will
Yeah,
take
because
them,
it's,
because
it's
it
a
was not up to them.
Universal crisis.
They did not do it. So we look at employment history, then 2-year tax return, W-2 form, and pay stubs, 1 month pay stub we look at. And we calculate income a little bit differently than what person thinking he's making. Say a person shows us W-2 form, he makes $120,000. But his base salary is only $80,000. The rest was overtime and bonuses. That's fine, as far as income is concerned. But if he earned the same way income a year before, in overtime and bonuses, that's fine. And third thing, if currently his pay stub shows that he's making that kind of income, and he's also getting some overtime, and he's getting some maybe monthly bonuses, or he will get bonus. So if he's not getting bonus right now, his employer paid him bonus a year ago, once a December month or November month, whatever. They just get a verification that yes, he will get the overtime bonus this year as well. So then we can use the overtime, average it out. Same thing, we average out the overtime, and then we take the salary and we add it up, and then we average it out. The
So-
average income is used,
So we say DTI,
DTI.
debt to income. So if somebody have very high income and very high expense, what's your advice for them?
Well, I say high income is excellent.
But high expense.
Debts they have to have. In order to get a mortgage, you should be consulting with somebody. I'm not saying with me necessarily, with somebody who knows how to work out these issues, these problems. Just to answer simply, if he has high balances, he should pay out his balances first before he buys a house. It's very, very simple. Buying a house is very easy. Keeping the house is difficult.
Yes. So we've been talking for a little while, and
Sure.
thank you. You shared a lot of stuff. It's time for a break. Can you go for a break?
Sure. No problem.
Viewers, we're going for an ad break. Please stay with us, and we'll be back soon. Till then, thank you.
Okay. So we're not
Yeah.
recording?
Yeah. Okay.
Okay.